Welcome to the Opening Bell Report.
Today, we're reviewing an investment analysis on Beyond Meat, titled Dead or Undervalued, the penny stock play.
Right, it's a high-stakes thesis. Is it a bargain or a trap? And our goal is to really rigorously test the bear versus bull arguments in this analysis.
Okay, let's jump right in. The first major point. The analysis of the $1.1 billion convertible debt maturity in 2027 requires, I think, a more granular explanation of what that actually means for the people holding the stock right now.
Yes, it correctly identifies this debt wall, which is accurate. But, my issue is that it kind of relies on financial shorthand.
Right, it uses terms like haircut or debt for equity swap.
Exactly. And it assumes the reader, even a smart one, intuitively gets the mathematical violence of what that means. It says the equity is underwater, true, but it stops short of actually illustrating it.
So if I'm holding a share at 76 cents, what does that swap actually do to me?
The report doesn't say. It leaves that ambiguous, and that really softens the blow of the bear argument, I think, unnecessarily.
I see. So the argument here is that the risk is too abstract. The suggestion, then, is that the report needs to bridge that gap between distressed debt as a concept and the specific outcome for the common stock.
Yes, it should explicitly model the dilution. Move from just, qualitative warnings to actual quantitative proof.
Stop hinting at the danger and start calculating it.
Precisely.
And to make that concrete, you could add, say, a scenario box.
Okay.
A small table that calculates the theoretical share count if even half of that debt gets swapped for equity at today's valuation. Let's just think about that for a second. Swapping $500 million of debt into stock that's under $1.
You're not just diluting shareholders, you're basically incinerating them. The share count would absolutely explode. You're issuing hundreds of millions of new shares.
That paints a very different picture. It moves it from, this is a bit risky, to, this is mathematically impossible for current holders to survive.
It shows the mechanics of the wipeout. And another easy fix would be to just visually compare the market cap to the debt. A simple bar chart.
The tiny $340 million equity slice next to the $1.1 billion debt tower.
It shows you just how far out of the money they are. But to go even deeper, the analysis would really benefit from explaining the concept of the fulcrum security.
That's a term that adds a lot of weight. How should the report use it?
Well, it's what distressed debt investors use to identify who really ends up owning the company after a restructuring.
So, in this case,
it clarifies that the bondholders essentially own the company right now, not the shareholders. The shareholders are just holding a lottery ticket, an option.
And if the report just states, the bonds are the fulcrum security,
it signals a much higher level of sophistication. It explains why the equity might be worth zero, regardless of the brand. It tells the reader, the company isn't going away, but your ownership stake probably is. The keys belong to the creditors.
That's a powerful shift. Okay, let's move to the other side of the argument, the bull case, specifically this acquisition idea. The argument needs to be challenged with a counter-narrative about enterprise value versus equity value.
Yeah, this part is fascinating because it relies on this very common assumption. The brand is famous, so someone will buy it.
We see that all the time.
All the time. The report says a Kraft Heinz or a Nestle could buy it for pennies on the dollar. But there's a huge logical gap there.
Which is?
Why would a strategic buyer acquire the equity now? If you buy the equity, you inherit the $1.1 billion debt load. That's the poison pill.
So the bull case feels a little optimistic without addressing that. Why not just wait for bankruptcy and buy the assets debt-free?
It's the classic difference between buying a house with a massive lien on it versus buying it at a foreclosure auction.
Right. If you buy the stock, you buy the debt.
Exactly. And that distinction is vital. So the suggestion here is to strengthen the analysis by focusing on the enterprise value, the EV of a deal, not just the market cap. The report has to address that why now question directly.
Because a novice investor sees a $300 million market cap and thinks, oh, Nestle can buy this for $400 million.
But the enterprise value is really $1.4 billion when you add the debt. Is the brand worth that much right now? That's the real question.
That really brings the price tag into reality. So what's a concrete way to fix that in the report?
First, add a section on the takeout premium required to satisfy the bondholders, not just the shareholders. They're owed par or close to it.
Right.
A concrete example would be to compare this to other distressed food acquisitions where the buyer waited for Chapter 11.
Like Hostess brands?
Perfect example. The Twinkie survived, but the stock got nothing. The report needs that context to show that a famous brand does not equal a safe stock. You could literally outline a scenario where Nestle buys the Beyond Meat trademark out of bankruptcy, leaving the stock at zero.
That's a grim but really necessary reality check.
For sure, and to make it even sharper, the analysis could specify who the buyer would likely be. It just says conglomerates now.
Too vague.
A conservative company like Nestle isn't going to touch this balance sheet. So a better suggestion is to pivot the analysis. Maybe the buyer is a risk-tolerant private equity firm. They love messy situations. They love leverage.
Whereas strategic buyers hate it.
Exactly. That shows the reader the analyst understands the difference between a synergy play and a financial distress play. It adds a layer of realism that's missing right now.
That's a great point. It elevates the analysis from just speculation to targeted financial logic. Okay, now let's look at the operational side. The report presents gross margin recovery and consumer fatigue as separate points, but the analysis would be stronger if it examined the tension between those two trends.
That is a critical observation. Right now, it's totally siloed.
It's like one section for the bear case saying demand is falling off a cliff, -13, -19% revenue trends.
And then a whole other section for the bull case praising the move to 10 or 15% gross margins. They feel like they're happening in different companies.
Right, it fails to ask the really hard question.
Which is that margin improvement even sustainable if your volume keeps plummeting? Are they just cutting costs to the bone at the expense of any future growth?
It's two parallel narratives instead of one intersecting story. So the suggestion is to integrate these two lenses, analyze if the path to profitability is even viable if the top line keeps shrinking.
Exactly. And a concrete way to do that is to introduce the concept of operating leverage, or in this case, the lack of it.
Okay.
The report needs to explain how fixed costs, the factories, the overhead, become heavier as sales drop. If your factory is built to make 1 million burgers and you only sell 10,000, your cost per burger skyrockets.
So even if the ingredients are cheaper, the net loss might not improve if the factory is sitting empty.
Precisely. You can't shrink your way to greatness. Another concrete example is to analyze that cost-cutting versus growth trade-off. Specifically, ask if the reduced cash burn is just because they stopped spending on marketing and R&D.
Which, if they did, would directly accelerate the consumer fatigue mentioned in the bear case.
Now you're connecting the dots. It turns two data points into a causal loop. Margins are up because they stopped spending on growth, which is why revenue is down.
It shows the reader that the good news on margins might actually be the cause of the bad news on revenue.
And visually, I'd suggest a chart. Overlay the revenue decline with the margin improvement.
So you can actually see if the lines are converging toward stability.
Or diverging toward total irrelevance. It's about the trajectory, the vector, not just a snapshot in time.
Okay, that brings us to the final section, the advice for traders. The report calls the stock a lotto ticket, which is an exciting narrative, but the discussion on delisting risks needs more tactical depth on the actual market mechanics.
I agree completely. The tone gets punchy here, which fits, but I wonder if it fully considers the mechanics of the death spiral.
It mentions NASDAQ delisting and reverse splits as a risk, saying it invites short selling.
Which is true, but for a trader, that's way too high level. It doesn't explain why it happens. The weakness is that lack of explanation of the death spiral mechanics that almost always follow a reverse split in penny stocks.
So telling a trader to watch for volatility is basically useless advice.
It's not helpful at all. They need to know about the structural traps waiting for them. The suggestion is to provide a more detailed warning about the risks of trading sub-$1 stocks, specifically liquidity and this is the key term, institutional abandonment.
Right. So what's a concrete example of that?
Well, expand on what a reverse split actually does. Explain that many brokerages restrict borrowing on stocks post-split, and more importantly, a lot of institutional mandates, pension funds, ETFs, they are forced to sell a stock if it stays below $1 or does a reverse split.
So it's not even about fundamentals. It's mechanical selling. Algorithms just dumping the stock.
Exactly. So even if your lotto ticket thesis is right, the market plumbing can flush the stock down anyway. The machine is working against you.
That's a huge risk.
It is. Another concrete example is to differentiate between a short squeeze, upward pressure, and death spiral financing, which is downward pressure. If the company has to raise cash, they'll issue equity at a discount.
Which just caps any potential upside.
It does. So instead of just saying, watch for volatility, the verdict for traders should define specific technical levels. Give them signposts.
What should they actually be looking for on the chart?
Right. For example, if it holds 70 cents on volume, the thesis is active. If it breaks 60 cents, the death spiral is confirmed. That gives them a go-no-go gauge. It makes the advice actionable, not just observational.
It does. It acknowledges that trading a 76-cent stock is a game of mechanics, not just a bet on a mission statement.
Don't forget to like, share, and subscribe for more.